Welcome to our research presentation and market outlook for the month of May 2022. The presentation contains the update on global markets, domestic markets, and fixed income markets along with our outlook. On the global market front, most of the global equity indices were volatile and ended the month on a negative note. Increased uncertainty about global economic growth due to ongoing conflict between Russia and Ukraine, worries over rising inflation, and expectations of a liquidity tapering and aggressive hike in interest rates by major central banks kept the equity market volatile. Meanwhile, central banks of some large economies, including US and UK, have increased interest rates following higher inflation and steady macroeconomic data. Going forward, market would be tracking the impact of expected liquidity tapering, which is likely to have a direct impact on equity valuations. On the China front, Chinese economy registered a moderation in growth in Q1 of CY22 due to COVID-19 led lockdown restrictions and heightened geopolitical risk. As per media report, in mid-April, 45 cities in China representing 40% of its GDP were full or partial lockdowns, which raised the fear of a further economic slowdown in China and global economic growth. But central banks and Chinese government are taking measures to support the economy. Commodity prices witnessed a mixed trend during the month. Industrial metal prices were down due to lower demand and expectations of a slower economic growth, whereas agri-commodity prices moved higher on the back of supply disruption and exports curbed by some countries to deal with their domestic demand. Macro data from developed economies are witnessing a steady trend, but various multilateral agencies have downgraded their global growth forecast for CY22, citing concerns over liquidity tightening and hike in interest rates by major central banks, ongoing conflict between Russia and Ukraine, and COVID-19 related lockdown restrictions in China, which could impact global supply chain. On the domestic market front, while Indian equity markets ended a volatile month on a negative note due to fear of aggressive rate hike by US Fed, it continued its outperformance versus peers over the last 1 year despite strong FPI outflows as sustained DII inflows supported the market. Meanwhile, supportive government policies and private capex are likely to drive the growth as consumer demand revives. Sharp deleveraging of corporate balance sheets would also provide support for future capex. On the rural demand front, increasing price of agri-commodities and rise in agricultural exports could improve realization for farmers and have a positive impact on their income. On the urban demand front, urban demand has stabilized over the last few months, led by improving job market scenario and improved consumer confidence. Meanwhile, household savings have increased significantly in last 2 years, possibly as a reaction to the COVID-19 condition, which could also help in reviving the consumption demand. On the domestic macro data front, most of the high frequency indicators like GST collection, bank credit growth, manufacturing PMI, amongst others, have witnessed improvement. However, rising inflation as seen by CPI and WPI numbers and deteriorating current account balances are cause of concerns. And with persistently high global inflation and rising domestic inflation, pushed the RBI to hike interest rates between the policy dates. On the corporate earning front, corporate earnings started on a mixed note. So far, 52 companies in CNX 200 index have reported their quarterly earnings as of 29th April 2022, and the net sales of these companies grew by 16.7% YOY and EBITDA grew by 34.8% YOY in Q4 of CY22. While the top line growth of Indian corporates remains the key, higher commodity prices and input costs are likely to impact the profitability of manufacturing companies, whereas higher wage cost could impact the profitability of companies from services sector. On the valuation front, S&P BSE Sensex is trading at 23.4 times of FY22 estimated Bloomberg consensus EPS of Rs 2400 and at 20.7 times of FY23 estimated Bloomberg consensus EPS of Rs 2750. This data is as of 29th of April 2022. In the long run, Indian corporates' profitability, which was at a cyclical low levels, is likely to witness improvement due to improving macro fundamentals, strong demographics, and rising capital investment supported by government policies. Hence, any sharp dip in equity market could be used as buying opportunities by investors with a 2 to 3 years investment horizon. Key risk to equity market could be following: ongoing geopolitical tension between Russia and Ukraine may have adverse impact on global trade and economic growth. Rise in volatility in commodity prices could put pressure on global financial market. Sharp volatility in US bond yields may lead to rise in risk of sentiments. Higher crude oil prices could put pressure on India's current account balances, are amongst others factors to watch out for. As far as the investment strategy is concerned for equity mutual fund, going forward, stable demand condition and rising capex could keep the earnings expectations stable, though the high interest rates could limit the PE re-rating. Given a slew of events ahead, market could move in a large range in the medium term, and return expectations from the market need to be muted relative to what we have seen in last 24 months. Hence, we continue to maintain an investment deployment strategy of 50% lump sum and rest 50% to be staggered over the next 3 to 4 months. Investors could focus on large cap, large and mid cap, value funds, hybrid equity funds, and infrastructure funds for investment with a horizon of 2 to 3 years in line with their risk profile and product suitability.
On the fixed income side, in a span of less than a month, the RBI hiked interest rates twice between April and May. In the month of April, the monetary policy of the RBI introduced standing deposit facility rate at 3.75% to replace the reverse repo rate, and also narrowed the policy corridor to 50 basis points from 65 basis points. On 4th of May, the RBI surprised the markets by making an off-policy increase in the repo rate by 40 basis points, consequently adjusting the SDF, the MSF, and the bank rates higher by 40 basis points. The CRR was also increased by 50 basis points, with a resultant withdrawal of Rs 870 billion of durable liquidity from the system. This shows that faced with several important tasks, the RBI could undertake faster and sharper than expected tightening of the monetary policy. The RBI may change the monetary policy stance to neutral from accommodative in the upcoming policies, and the possibility of further hike in policy rates in the June policy cannot be ruled out. Several factors are likely to put upward pressure on domestic inflation. The Russia-Ukraine war has led to rise in prices of several commodity prices, raw materials, thereby leading to sharp rise in input costs. Apart from industrial commodities, input costs of agri-commodities and food have also been rising. To add to that, in India, the current heat wave may lead to reduction in crop yields. Demand conditions are also likely to remain strong given the pent-up demand with subsiding COVID pandemic. Thus, CPI inflation is likely to rise further and stay above the RBI's inflation target range of 2 to 6% in the near term. Over the next 12 months, inflation is likely to be a key monitorable and is likely to have major influence on policy decisions globally. Domestic liquidity surplus declined in the month of April, wherein net liquidity adjustment facility being at a daily average surplus of Rs 538 trillion in April as compared to Rs 641 trillion in the month of March. Along with variable rate reverse repo auctions, the RBI also conducted USD INR sell-buy swap auctions, which also contributed to decline in liquidity surplus. Liquidity is now moving in line with the RBI's plan of withdrawal in a calibrated manner, which may be essential in taming inflation. On the other hand, the RBI has to ensure smooth completion of government borrowing for FY23. Lesser liquidity coupled with high GSEC supply could crowd out corporate bonds, thereby increasing borrowing costs for corporates. Domestic bond yields remained volatile and closed on a negative note in April, wherein yield on the 10-year benchmark GSEC closed higher at 7.14% as of end of April, as against 6.84% as of end of March. It further rose sharply to 7.38% on 4th of May after the RBI's repo rate hike. GSECs opened on a negative note during the month, tracking caution relating to higher supply of GSECs. GSEC yields rose further sharply, tracking outcome of the RBI's April monetary policy, decline in liquidity surplus, volatility in crude oil prices, and hawkish comments from the US Fed officials. The US Federal Reserve raised its key policy rates by 50 basis points in line with expectations in its latest monetary policy. More importantly, Fed's balance sheet reduction will happen in phases starting June 1st. Retail inflation in the US surged to a 4-decade high of 8.5% year-on-year in March from 7.9% in Feb. With the US interest rates rising at a faster rate, emerging markets are likely to witness outflows resulting in pressure on their currencies. Emerging markets saw outflows in the month of March, as per reports, as against inflows in the month of Feb. This, along with inflation being high globally, is likely to prompt many central banks to raise interest rates faster. Global bond yields are likely to witness volatility and trade with upward bias as central banks continue tightening monetary policy. The domestic yield curve shifted upwards with yields rising in the range of 9 to 52 basis points across the curve. The short and the medium end of the yield curve witnessed higher rise in yields as against the longer end. Yield curve remained steep with a spread between the 1 and the 10-year G-Secs being at 233 basis points as of end of April. The steepness between the 1 and the 7-year segment continued to remain high with term spreads being at 223 basis points. After the 7 years mark on the yield curve flattens out relatively. With the spreads between SDLs and government securities being very low, the spread between corporate bonds and SDLs have turned negative. Deleveraging by corporates and lower bank lending rates have led to sharp decline in corporate bond issuances during the rate cutting cycle. Going forward, bond markets are likely to be characterized by volatility, tracking global geopolitical tension and fears of their impact on global as well as domestic economy, monetary policy normalization by major global central banks and the RBI, higher supply of government securities domestically and domestic inflation trajectory. In a scenario of expected volatility, yields trading with an upward bias and current steep yield curve, investors could look at fixed income strategies with superior credit quality portfolios that provide visibility of performance and allow locking in current attractive term spreads. In this regard, debt index funds that have target maturities and invest in a mix of high credit quality securities can be looked at. As interest rates rise, liquidity surplus declines, and in the face of large government borrowing program, the corporate bond spreads could witness expansion after witnessing one of the sharpest contraction during the easy monetary policy regime. This could impact portfolios that are oriented towards corporate bonds. Thus, in terms of fixed income mutual fund investment strategy, investors who have relatively longer investment horizon could look at target maturity index funds that invest in a mix of high credit quality securities. Investors with an investment horizon of 12 months and above can look at short duration funds, money market funds, ultra short duration and low duration funds. With the rise in the yields at the longer end of the yield curve, investors who are comfortable with volatility and have a longer investment horizon could gradually start looking at dynamic bond funds. For a horizon of 3 months and above, arbitrage funds can be considered, whereas for a horizon of up to 3 months, investors can continue to look at overnight funds and liquid funds. Investors should invest in line with their risk profile and product suitability. That is all on the research presentation for May 2022. Thank you, everyone.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.